Sounds good.
Well, we want to welcome everybody to the call tonight with David Rumsey, CPA, IAR, and president of Pettis Rumsey, Inc., CPA firm in Marysville, Washington. If you're not a client of David's already, David handles tax, accounting, bookkeeping, just about anything financial, investments, with hundreds of clients there in the Snohomish County area, and he is a contributing editor to the Snohomish County Business Journal, which you can find I think it's SnohomishCountyBusinessJournal.com online, and he writes a monthly column called Tax Talk. And so tonight, David is on the call, and we're going to be talking about tax changes for 2011 and maybe some 2012 and beyond. David, I think you went to a CPA class where they talk about all this for 2 whole days, probably very exciting, and you're going to try and boil it down for us all tonight. So, David, welcome to the call.
Thanks, Jeff, and welcome everybody. I appreciate you taking time out of your schedule to listen in. And at the end of the call, we're going to open it up if there's any questions that something I talked about that you might want a little clarification, or if there's an issue that didn't come up in the conversation, I'm happy to answer that. Just be aware that there could be other people listening, but you're always welcome to email me with any questions or anything as we're getting kind of geared up around the office here for the 2011 tax season. So Jeff's right. About a week and a half ago, I was in Linwood down south, and the office for the most part was there as well, and we were going through our tax update. This is a 2-day event. First day is usually geared towards individuals, and second day business. So obviously a lot of those cross paths, and the two are have some things that if you have a business, it also affects your individual. So we're looking to make sure that we kind of talk about the new things, and some of the things that come up over and over again are just things to want to remind you going forward. And like I said, we'll open it up for any general questions or anything at the end, so everyone will have an opportunity to go from there.
And David, I'll jump in real
Sure.
quick and just remind everybody that if you receive the confirmation email from David, we had note sheets attached, and it's 2 pages. I think if you have those printed out in front of you, we've got the different headings that, David, you're going to be talking about, and so they can probably take notes and fill in the blanks. So if you have that, go ahead and print it out, have it in front of you, and we'll follow along then. So,
excellent. Well, we'll focus, number one section is the first section for personal income tax changes, and we'll just talk about some of the basic things and then work our way through things from that nature. Number one, everyone that is being able to be claimed as a dependent, that's called an exemption, and that amount slightly increased to $3,700 per dependent. So for every dependent that you're able to deduct on your return, you get a reduction of your taxable income by $3,700 for each one. If you're filing the standard deduction, which means you're not itemizing in most cases, you automatically get a basic deduction. Married filing jointly, $11,600. Married filing separately, $5,800 this year. And head of household is $8,500. Single is also $5,800. So what that means is at a certain level, you're for sure going to have a certain deduction that you will be able to take, no matter whether you own a home, whether you pay a lot of real estate taxes or make a lot of donations or medical expenses, that you'll be able to take this amount even if you don't have that. So any married couple, for example, gets a standard deduction of $11,600 for 2011. If they have mortgage interest, property taxes, donations, medical, things of that nature that's higher than that, then they can certainly file Schedule A and be able to take the higher of the deduction. But at this point, you know you at least get this amount off of your taxable income. Remember, a deduction, just as a reminder, is reducing your taxable income. It's not lowering the tax dollar amount, but it is lowering the amount of income that's used to figure the tax on. The second area is tax rates. The good news here for 2011 and 2012, these are the same rates that we've been dealing with for quite a while with the Bush tax cuts. So there is no change in the percentages. The brackets do widen a little bit due to inflation adjustments. So, for example, if the taxable income could increase from 15 to 25% for a married couple once they go over, I believe it's $69,000 of taxable income. So that changed a little bit, but for the most part, you can put income in 2011 and 2012 and expect the same rates. One thing that's really interesting as far as tax preparers are concerned is always, are there any new forms? Are there any changes to the forms? And we want to make sure of a couple of things that you're aware of. Number one, there is no Schedule A or exemption phase-outs for 2011 based on your income. Typically in the past, the higher the income, you might start losing some of those standard deductions or exemptions that we were talking about. This is not the case for 2011, so everyone's able to take their full deductions irregardless of their income. Schedule C, which is a schedule attached to your 1040 if you have a small business, a sole proprietorship, or a single owner LLC, now there's an item asking for credit card sales. And what the government is doing is they are trying to make sure that they are getting to know how much income a business is taking in off of credit cards or debit cards. Credit card companies and banks are going to be required to report this to you if you have a business that takes credit cards. The good news is, because they were having a hard time getting this implemented, you will not be required to put that on your return, so you'll put a 0 in there. But in the future, as the law reads now, you will have to have that information to break out how much of your sales were actually on a credit card versus check or cash or other payments. Schedule D, for example, also had some changes. Lots of stock sales, you need to list that on a Form 8949, not the Schedule D1 form that we had in the past. So there's a few minor changes there. For the most part, though, you'll see that the form changes are pretty much the same. Capital gains and tax rates, this is always a topic that comes up. It is still 15% if you're in the higher brackets of 25% and up, but it's actually 0%. I had a few people last year that lower income, but they had some capital gains, and they paid no taxes on it. Perfectly legal. It was, again, in the Bush tax cuts. I suspect this will go away. So while I'm not here to predict the future of what tax rates or Congress and the president's going to do, and whether it'll be the next Congress, the next president, or continuation or combination of both, we don't know what they're going to do, but in light of the deficit situation, it wouldn't surprise me if capital gains increase after 2012, after the election year. So this gives us a planning opportunity in 2011 and 2012 that perhaps you could be looking at the lowest capital gains rates we're going to get. Now, I could be all wet here and we may not have that, but it's something definitely to think about because historically these are very, very low rates and you can take advantage of that at this time. Whether you'll be able to do it after 2013 or at some point during that year will remain to be seen, but it's something to be aware of. The good news is for 2011 that did not increase and we can still have some clarity about the capital gains. Letter E, foreign bank accounts. This I found to be kind of disturbing, but at the same time, whether I agree or disagree with it, it's my job to make people aware of it. They being Congress and the IRS, wants to be aware of what's going on with foreign bank accounts. And if you have an interest or a signature authority in a foreign bank account that exceeds $10,000 at any time during the year, you have to file by June 30th a Form TD-F. And there could be penalties up to $10,000 for not filing this form. Now, I want to make sure everyone understands they're not making you pay tax on this, but they're looking to see what Americans have in these foreign accounts. There's been a lot of press in the last few years about the accounts, the Swiss bank accounts, the Cayman Islands, things like that, where there's money being held outside of the U.S. by U.S. citizens and no taxes are being paid, things of that nature. So they are now requiring people to document. And the key thing I want people to get out of this, it's not that, oh, I had less than $10,000 per year or at the end of the year in this account. It's that any day out of the 365, if you were over $10,000, you have to file this information return by June 30th. Now, this will be probably something they've kind of had it for a while, but now the emphasis is getting much tighter that they want people to do it. I'm based out of Washington State. I'm not very far from the Canadian border. There's lots of Canadians and American trade going on at any time and have been for decades. So it's not unusual for us to have clients that have accounts in Canada. They may just be savings accounts or things like that. We need to make sure that we're getting that information. We will be asking for that information from our clients because we have a responsibility to make sure we're getting the information and helping the clients from that. So be aware, we're not trying to totally butt in and know all your business. Apparently the government may be doing that, but we want to make sure that you're not going to get hit by this penalty. It will not, though, increase your tax. Cancellation of debt income. That is an area that really hasn't changed, but I want to make sure people are aware. If you have had debt forgiven, be it a credit card, a car loan, things of that nature, where debt was canceled, you didn't have to pay the full amount back, you can and most likely will receive a 1099-C form. This form allows the bank to report that this amount of debt was not included or did not get paid back. By Congress rules and the tax code, that is income. And that 1099-C will get caught by the IRS. They get a copy of that form. If you leave it off and say, hey, what's this? I don't need to tell my tax preparer. I'm not. If I do my own, it's not going to be on there. You need to make sure to be aware. It is required to be put on your tax return. Now, what I do tell people is if you were insolvent, for instance, you may not owe any money on this cancellation of debt, but we do need to file the appropriate forms to indicate that, to make sure they understand that, yes, we had some debt canceled, but we were insolvent. And a lot of people are having debt greatly reduced or canceled in this case because they're insolvent. They don't have the means to pay for it with the way the economy has been the last few years. So make sure that you get your tax preparer, whether it's myself or anyone else, the 1099-Cs, and make sure that they're aware of your total situation so they can take advantage of any exclusions if apply. The next area that we want to focus on is energy tax credits. And what I would say there is there are still some credits out there for doing energy efficient improvements for existing homes. The problem that I see is they're not as good as the last few years where we've had upwards to $1,500 to in the thousands of dollars potentially if you invest back into your home with Energy Star type items. They also will be limited based on whether or not you've taken any energy credits in previous years. But for instance, there's a credit for advanced or improved fans, furnaces, gas, propane, oil furnaces, hot water tanks, windows. So be aware that if you made any energy efficient, and typically the manufacturers or the contractors have paperwork that will tell you if what you did qualifies, make sure we're aware of that, because this is a tax credit. And even though it may be $200, $300, $500 at max for this year, that's $500 directly off your tax bill. It's not a deduction, so it does have much more bang for the buck. And why not take advantage of the credit? If you did something to help save energy, reduce your energy costs for your home, and you haven't taken advantage of the credits before, or maybe not fully, we want to make sure you're aware of that so you can get that. So hopefully we'll see some bigger credits, and things like that. There's lots of things on the websites out there that will tell you if your property qualifies or not. We're happy to do that as well for you. As well as the bigger these improvements are, you can also take advantage of the sales tax deduction. That's not listed on your note sheet, but we're still able to deduct sales tax here in Washington State. We don't have income tax like many states do, so we can still take sales tax on major purchases, whether or not we've used the energy credit prior or not. So there's potential for two types of, either one being a credit or a deduction for these energy improvements. So be aware of that. Education credits, there's not a lot of change there, but here again we're talking about credits. So the American Opportunity, which used to be known as the HOPE tax credit for college expenses, has been extended through 2012, so it's still applicable, obviously, for 2011's returns, as well as the lifetime learning tax credit and the higher education tax deduction. Each one of these have their own special requirements, but if you or any of your dependents on your tax returns did have some college expenses, we certainly want to be aware of it to see if you qualify for either the credits or the deductions. And these credits can be pretty substantial, $2,500 on the first $2,000 in qualified expenses, plus 25% of the second $2,000. So it's a nice tax saving to go towards paying for these college costs, which continually seem to increase all the time. So be aware those are still out there. Not all of them are equal as far as their deductibility and how they may apply to your situation, but there are some opportunities if you're going to college or you have dependents that you're claiming on your return that had some higher education costs. There may be some real benefit there. I always mention retirement plan changes. The positive here is you don't have to learn any new amounts for the most part during 2011. For an IRA, it's still a $5,000 contribution limit. If you're over the age of 50, you can put in an additional $1,000. 401ks and things of that nature have, for the most part, pretty much stayed the same as well. So while they do talk about constantly that, hey, we're going to increase these amounts, for instance, 401k for 2011 is still $16,500 that you can put away. If you're over 50 and your company allows you to put away an additional amount, you can put away over a total of $22,000. Simple IRAs, defined contribution plans, all of those are still at the same contribution maximums or limits that we had in 2010. This is still, though, a great way to reduce taxes, be it here, there's still a few weeks left in the year for any 401k or employer retirement plans that maybe you can ratchet up your contribution to get a little bit more deferred. And then obviously you still have till April 15th to make any IRA traditional Roth contributions, SEP contributions, things like that, and still get the benefit on your tax return. So positive is you don't have to learn any new amounts. The negative would be they're not letting us put away more if we're able to. Hopefully that will change as to encourage people to save more for retirement and help fund their own retirement going forward. I'm going to talk about 1099s, but I'm going to put that towards the end to make sure that everyone is aware of that, because that's actually one of the bigger topics that we want to make sure we're aware of. One thing that comes up, though, in the practice, it's not on your list, but I kind of in my research thought, this might not be a bad thing to remind people of. And I get this question probably 10 to 15 times every tax season. And what proof do I need to show documentation for charitable deductions? And the answer that most CPAs or tax preparers or enrolled agents are going to give you is it depends. That answer is our favorite answer on almost all tax questions, but it really pertains to donations. So I'm going to just go over a few things that we see kind of on a normal basis. Hopefully this will give you a little bit of hints or helpful tools to make sure if you were ever audited and they wanted to look at your donations, you need to have this. And obviously I would tell people, the higher the amount of your donations, the more you need to make sure you have the paperwork, because frankly, your audit chances are slightly higher. So for instance, if you make a single cash contribution of less than $250, if you have a canceled check or a bank record, credit card statement, or a written acknowledgement from the charity, any of those will be good to back up that. If you do, though, give them more than $250 as a single cash contribution, you need to get written acknowledgement from the charity. And this is never a bad idea for any of these. Make sure, I think it's very important to have a piece of paper documenting how much you may tithe to your church, how much you may have contributed to your school's fundraising. A lot of those organizations are very good at giving you paperwork. It's not a bad idea, though, to make sure you have it in all cases. Perhaps you have a payroll deduction going to your favorite charity, say United Way, Big Brothers, Big Sisters, things like that. It's a good idea to make sure you have your pledge card and a W-2 or pay stub to back that up. A big one, though, is the non-cash. This is obviously going to the Goodwill or donating property of different types. What do you need to do? If you have a non-cash contribution less than $250, written acknowledgement from the charity, best thing for you. As well, if the contribution is between $250 but less than $500, have a written acknowledgement from the charity. If it's over $500, we as the tax preparer is going to have to do an additional form, 8283. But there again, you still should have written acknowledgement. The bigger the number, the more likely you better have written acknowledgement. If you're donating a car, real estate, or things like that, it's a good idea, and in most cases required, that you have some sort of an appraisal. And that appraisal needs to be sent in. You can't just say, hey, I donated a $7,000 piece of art here or something like that. We've got to be able to show that there's an appraisal. Attach a photo, send that in. It's never a bad idea to take pictures. The bigger the donation that's non-cash, it's not a bad idea to take pictures to document that you did it. If you had 20 bags of clothes and you're deducting $3,000, I'd take a bag of those things loaded in the truck or the van and ready to go, as well as the written acknowledgement. I do realize when you go to Goodwill, in most cases, they just give you a blank slip and they sign off on it. So there is some kind of your honor code that you have to be aware of here. So I would tell everybody, make sure that you keep those receipts and that you have as much documentation for them. Obviously, if you're only doing a few hundred a year, it's not going to be a big deal. In most cases, you're not going to raise any red flags with the IRS. The only issue you would have is if you're being audited for something else, and the IRS said, oh, by the way, let's back up these contributions, which I've seen a few times that it can happen if they are in that mode. Schedule E is an interesting form as far as it has some changes as well. If you pull up a copy off of the IRS.gov website, Schedule E now wants to know and requires you to put the address of the rental property. This is Schedule E, page 1, is where you report rental activity, be it from commercial or residential properties, even multi-unit properties. So they want an address. They want more details. So the old days, people could just put rental house, Washington State. That was fine. Now they're wanting to tie this to the properties. This is more of the cross-matching. They have estimated, they being the IRS, that there's millions of dollars of uncollected tax revenue from people over-reporting expenses, taking passive losses when they shouldn't have with rental properties, or, frankly, people not reporting all their income. So they want to make sure there's more detail about these properties. They want to know the type of real estate that you're renting out, and so just be aware of that as well. There's also a question about 1099, similar to what we'll talk about in a minute. The IRS or Congress got that law basically repealed, so you're not required to give 1099s on rentals like we were going to have to do if paid over $600. They still, though, ask you on the form about 1099s. So we definitely want to make sure that we're answering those correctly we being ourselves, the preparers, and obviously the tax client who needs to sign the return. The thing about this is people will say, well, I'm just, not going to put all this information down. Well, the IRS is requiring us as tax preparers to e-file returns. And one day, I truly believe there won't be much of a choice. You're going to have to e-file all returns. We're almost there now, frankly. So these are things that they would require before we could submit your return, i.e. you could receive your refund if you have one coming. So these are things we just have to jump through the hoops, unfortunately, or write our congressmen or women to get these laws changed if it's going to where it's at. So be aware of that. There is more requirements whether you do your own return. Your tax preparers are not trying to snoop around. We're just trying to get the required information to file a complete and accurate return and not to increase your chances for any audits. The second chapter, the second section, is business tax changes. And there frankly really aren't a huge amount of changes. Overall, even in the individual side of things, the good news is there is a lot more consistency for planning purposes over the next year or so than what we've had over the last decade. We've had plenty of tax law changes, and that just confuses everyone involved. So feel free to take a break this year. That most of the return is very similar to last year, and that's kind of nice for a change. I suspect that that will change in the next couple of years, so we'll just take what we have right now. Number one, auto expenses. The IRS is in charge of letting us know how many cents per mile we can deduct for our business, rental, charitable, medical type of driving. I'm focusing here on the business. It's 51 cents per mile for business from January through June. And then due to gas and operating increase cost, they increased the mileage to 55.5 cents per mile for the months of July through December 2011. So we're required to report an estimate of your miles, if not the actual miles, as best we can. I always tell my clients you need to know what your total miles on that vehicle were. I also tell people there's now an iPhone app from Apple that will help you track your mileage much, much easier than the old days where you're required to have the mileage log, and the only way you could do it was either write on a calendar or hand write it. This tracks your mileage. You just put it in the vehicle. You click done when you're at your destination. It will send the information to an Excel spreadsheet. You can print that off, and there you go. You're ready to go, and you've compiled your written requirements for a mileage log. 1099s. The IRS is now asking you on its forms 2 questions, and this is on corporate returns, Schedule Cs, partnership returns. It's on there. The first question, did you make any payments that require a 1099 form? So in other words, did you pay any individual over $600 in combined payments? Could be one payment or 1,000 payments. If it's over $600 to an individual, you are required to send the 1099 to the taxpayer as well as a copy to the IRS. This is something that has been very lax, in my opinion, over the years. But those things have changed. So now they're asking you this question. You want to be able to say yes. I'm not here to coach you, but I'm telling you these questions are basically audit tools. The second question, which is even more in your face about this, if yes, did you make payments that require 1099s, did you or will you file a 1099 form? So obviously they're wanting to know, do you have the requirement to file 1099s? You could say yes, that's great. But the second question is the kicker, because it's going to say, hey, well, you said yes. Did you or will you? Now, I don't know will you means, oh, whoops, I found out that I needed to file this 1099. My accountant told me this in March. Obviously, that's way past the deadline by about a month and a half, 2 months that you were supposed to send these to the IRS. We will file the 1099 and get the paperwork ready for you. So you, going forward in future years, you probably would not want to miss these things, and you'd want to send that individual a 1099. So, for instance, I have a gentleman who comes in. He does the windows in the building here, and he is paid just a little bit over $600 for the year. I'm going to have to get his name, Social Security number, if I believe he's a sole proprietor or an individual, and get that information and send him a 1099. I'm very confident he reports the income I pay him, but the IRS is saying, hey, you have this requirement. You paid over $600. Did you? If you say you did not, I'm pretty confident you're looking at the IRS sending you a real basic letter wanting to know more information. They've increased the penalties for not doing 1099s from $50. I had a couple clients say, they want to fine me $50 for the couple of them, no big deal. Now they're $250. So if you've got 10 people that should have gotten 1099s and you didn't do it and the IRS finds out, you are subject to $250 penalties for each one of those forms that you should have sent. I think you're also filing a return where if you knowingly knew you should have and understood the rules and you just flat said no or basically lied, then you're potentially filing a fraudulent return, which is not an area you want to go in, obviously, because the word fraud brings in potential criminal as well as civil. So from my standpoint, I have to sign that return with you if I'm your tax preparer or whoever your preparer is. So we want to make sure that you're okay. There's a lot of people that will not be required to do 1099s because they're not making payments to individuals. They're making payments to businesses or things like that. But there are also a lot of people that are paying individuals. So we're going to have to get this information in order to make sure it's not worth it, is my view, for you to have to take the risk for someone that's not filing their income and things like that. So these are on all the forms that have deductions, business deductions, and you're going to have to potentially answer these questions multiple times on your filings going forward. This is an audit tool, and I'm sure they will use it to try to catch people. And you could potentially be fined. You could potentially lose the deduction, so it's something to be aware of. Section 179 and bonus depreciation are still in place for 2011, and it will be in place as well for 2012 of some dollar amount. But right now for 2011, small businesses that were able to buy equipment, be it vans, trucks, machinery, they could write off up to $500,000 in the first year. Now, you can elect not to do that. You could take it over a period of years if that makes more sense. This is always an area I tell people you want to do some tax planning for, because some years deductions are worth more than others, and we want to be on top of it. But it's an awesome way, and this is still something that can be done. If you're looking, you've had a decent year income-wise, and you need it would be advantageous to purchase a new van, you could still do that, get it placed in service by December 31st, and you are able to take the deduction 100% up to $500,000. So it could be a very nice tax savings if you're in a higher bracket and you pay $20,000 for this van. You're in the 25% bracket for tax purposes. That's $5,000. Basically, you get right back as a reduction from your taxes. So that's always something to look at, to be aware of if you purchase any major assets or improvements or things of that nature. Not really improvements, but equipment, either from this point prior or through the end of this year, that you could take advantage of that. There is still some health care tax credits for employers that pay health insurance for their employees. They're small companies, usually they're under 25 employees, and the average annual wage is under $50,000. There is a maximum 35% of your health insurance premiums that you can get a tax credit for. So please be aware of that. If you pay health insurance of any amount, make sure your tax preparer is aware of that to see if you qualify for this credit. with the way healthcare costs are to provide insurance, this is something to help you get a fair amount of money back if you can qualify. A few other things as far as forms and things to be aware of. There's a Schedule A that's part of a Schedule C for cost of goods sold. That has disappeared, and now there's a Form 1125A that things like subcontractors, materials, they want a little bit more detail, I believe, with this. So if you're on it, have a Schedule C and have cost of goods sold expenses, that's going to be a new form for you for 2011. We've been telling this for the last couple of years. If you provide health insurance for any of your employees for 2012, not 2011, as of the current date now, you are required to put the cost of the health insurance premiums on the W-2. Now, a lot of people are out there still saying that in 2012, people are going to have to pay tax on their health insurance. That is inaccurate as the law reads current. And at this point, I don't see this changing. But they do want to be aware and know if you are paying any health insurance on behalf of your employees, that you put that premium amount for the calendar year on their W-2. So it's usually box 14 where employers put informational things on there. That's where this will most likely go. And so I always tell people it's better to be aware of these record-keeping changes at the beginning of the year as opposed to December 31st and trying to scramble the 31 days in January to get all this information. So you need to make sure you have good records to track how much premiums you paid for each employee during the calendar year, and that can get put on the W-2s. IRS Watch, they are auditing more and more payroll tax returns. I'm not sure exactly what they're going to get out of this because most people do file their returns accurately for their payroll taxes. They are probably, though, looking for misclassified workers or things like that. Be sure if you have those issues with 1099 subcontractors, you need to talk to your accountant or your advisor to make sure that you're doing things right there, because there is more emphasis and agents coming out to say, hey, I want to audit your payroll. They're not there looking at should you have deducted this legal expense or not. They're not that. They're focused on payroll. We haven't seen a lot of these for normal business audits, so this is something relatively new, and just be aware of it could happen as a way for them to gain more information to you and your business. I also like to remind people, S Corporation shareholders, if your S Corp is paying your health insurance for you or your family, you are required to put that in box 1 of your W-2 and make sure, this is for anyone, S Corp, Schedule C, 1065 LLCs, that you are cross-referencing your totals of your employees' W-2s and the W-3 form to your 4 quarterly 941s. Every year we'll get letters from Social Security saying, hey, what you reported on your 941s don't match the W-2s. And they will penalize you if you don't respond. So our office has always been, let's double check to make sure that what we say on the W-2s add up to what we reported to the IRS. Remember, W-2s and W-3s go to Social Security. The 941s go to the IRS. They get together for a little chat, I'm assuming in the spring or summer, after those have all been filed, and they do a quick check and comparison to see, do my 941s equal the W-2s? Most of them do, but if they do not, you will hear from Social Security saying, what's up? These are not adding up, and we need to get this straightened out. Because remember, that's how the employee gets credit for their Social Security benefits down the road, is by filing a copy of the W-2 so Social Security knows how much the individual made as far as if they're an employee. So, Jeff, that's pretty much it. We kind of jumped all around. There wasn't an area of the tax law that really changed dramatically. So hopefully there were some good things there, but if there's something that people have or want to get a little more clarification, I'll do my best to try to answer it.
Okay, David. The lines are open, so if you've got a question, just go ahead and say something, and Dave can answer your question. Anybody have a question tonight? Well, David, I don't hear any questions, so that means you've done a perfect job of answering.
I don't know about that. But you're making me feel good as I end the day, I guess. So, like I said, if anyone wants to, something came up, and I understand there might be some detail that people don't want to share, but if this sparks something, you're more than welcome to email me, david@pettisrumseycpa.com, and I'm happy to answer any of those questions via email as well.
Okay. David, I think we do have a question. Rocky, is that you in Snohomish?
Yes. I came
Hi,
in
Rocky, what's up?
I came in about a minute and a half late, and I didn't catch all the very first one, exemptions and the deductions.
Yeah, well, the focus on that, they did slightly increase from 2010. The exemptions are obviously for any dependents, you and your spouse, and if it's a situation where there's other people in the household that you can claim as a dependent, you're going to get a little bit more money, $3,700 off your income for last year. And the deductions also increased slightly, so that if you're filing a married filing joint return, for example, there's a deduction of at least $11,600. In your case, you may have more mortgage interest and property taxes, and we're obviously still could take the higher of those two deductions for the client.
Thank you.
You're welcome.
Any other questions out there? Go ahead and just say something. The lines are open. I think somebody needs to answer the door. David, let me ask you this. From an employee standpoint, next, I guess it's in January. If from a timing standpoint, when are employers sending out all the forms so that the employee has something to work with?
Actually, and that's both employers and the banks and the investment houses. Things are supposed to be mailed out postmarked January 31st. So I tell people, you can call and see if you can get it sooner. The good thing is, like a lot of the 1098, the mortgage loans and things like that, a lot of that stuff is available online sooner than receiving in the mail. Some of them just say it's online, go there, as opposed to, because they don't want the mailing costs. So you might want to be aware there. But, for instance, your employer, though, has the right to say, we'll send the W-2s out on January 31st, and they've complied by the rule. So we see that a lot of times where people are waiting for one or two things, and then they could do their return early. Usually the IRS doesn't open the e-filing up until around the 10th or so, I believe. So I haven't heard the exact deadline or start line, I guess, for lack of a better term. So you have till the 31st to wait. If you haven't received it maybe by the first week of February and they don't offer the online, then I certainly would start rattling cages or making phone calls, because they should have had them postmarked and out to you by that time.
Okay, that makes sense. And from an organization standpoint, are there any tools that you have available to send out to clients, or that you've sent out that can help them prep so that they're not waiting until April 15th, I guess?
Absolutely. We still send out organizers to our individual clients, and the beauty of the organizer that I've always appreciated is in usually the right column. I haven't seen it this year, but I'm assuming it's going to be close to the same format. You can see what we filed previously for you. If you are a new client, we're happy to enter in your previous year's return, and that will allow you to get sent an organizer for 2011, even though we may not have done that return, the 2010 for you, and that costs you nothing. It kind of helps us get things set up and going on it. But that organizer will also ask necessary questions, one, that we're required by law to ask you, and two, that we're asking you to make sure we're not going to miss anything. And so that organizer, while giving you an idea of what you reported last year, the W-2s, the investment, the type of deductions, things like that, it will also hopefully stimulate by answering probably about 2 pages of yes/no questions to make sure that we're not missing anything. So those are the type of things that organizer, we try to email them to our clients, their password protected and security protected. We're also happy to mail them out if someone wants, or they can swing by the office and get one to help them get ready.
Great. Sounds good. Well, David, thanks a lot for providing this information. It sounds pretty complicated. If anybody needs a question answered, what's the best way to get a hold of you? Email or phone or both?
Email's the best as far as because I can be out of the office and still see the question and try to get your question answered. Obviously, if it's a little more complicated, I'm happy to call. But if you're, hey, is this deductible or can I get the benefit of this? I'll certainly try to get back with you on that so that you can be prepared, particularly as we're in the last couple of weeks of the year end. So if there's something we need to do right away, that's good. There's also the website, which thanks to Jeff, have been able to build up some good tools and information that things like this call are there archived and that people can go back and listen to various subjects. So hopefully that would help them as well. So feel free to give us an email. You can also call the office at 360-659-8502, and we're happy to set up an appointment or get you whatever information to try to work with what you need.
Okay, great. David, thanks so much for being on the call. We appreciate everybody taking time today to listen in, and if you do have any questions, let David know. So thanks again, David, and we'll talk to you soon.
Thank you. Thanks, everybody.